Thank you for tuning in. So in this video, I will be lecturing on the seek and destroy um, market profile. So the algorithm um, has different days, or rather, it has different profiles it will choose for the day. So on the days where the algorithm um, chooses the seek and destroy profile, you you don't want to do much trading on that day. But if you're brave enough, I'll be teaching you how to anticipate such a day or such a session, a seek and destroy session, and then hopefully you can get on the right side of the market on this day. So on this day, Nasdaq, we had a bullish seek and destroy day. How is it bullish? Well, the thinking comes from, remember Monday? Monday was bullish, NFP. I made a video on how to trade NFP on NFP. So you see that rally higher. I spoke about this buy side liquidity above the initial move of NFP. Buy side liquidity there. So all this rally higher, it it kind of tells you or gives you a hint, an idea of where the market is, what the market is doing, or where it may be going. It left a low here, and then came back and took out sell side below that low, consolidated, created relatively quite lows. This is Sunday, so this is when it opened on Sunday. Created relatively quite lows, and then ran through them, and then opened for Monday's trading. As soon as it opened, it formed a high there in the London session, and then they ran through this low, collected sell side liquidity below this low. They collected sell side liquidity below this low, formed a swing low there, swing high there, gets taken out. It gets taken out impulsively. Okay, before I proceed, or I get any further with explaining what the algorithm was actually doing at every, I think this is every 5 minutes in time. Look at this chart. Let me quickly just remove this. Look at this chart. Does it look favorable to you? No. Does it look like the market is going in one direction? No. What is the market doing? The market is trapped. It's range bound. It's consolidating between the high formed in London and then the low formed in London. So all throughout London, we're range bound. We're just taking out liquidity above highs. We're creating liquidity above highs and then running through them. We're creating liquidity below lows and then running through them. We're just consolidating even throughout the New York session. We enter the New York session. What am I looking at? I'm looking at Nasdaq. So we enter the New York session there at 8:30. Enter the New York session there at 8:30. We're still trapped in between the low. So even during the New York Open, we struggle to take out that low. Even closer to the 9:30. So let's see what happened at 9:30. At 9:30, this candle, we're still failing to break above the high formed in the London session. So you're looking at this during the New York, right? As you might have noticed, I mostly look at New York. So at New York, you are seeing that The swing high formed in London session and the swing low formed in London session are still unviolated. In other words, the market is range bound, it's consolidating. Visually seeing is consolidating. But what is algorithmically happening is that the algorithm, the prices, the algorithm is offering prices in between this specific swing high and this specific swing low. So whatever upward or downward price it offers, it is in between this. It's range bound, it's trapped. So when you see something like that, you identify, you rather anticipate it being a seek and destroy. So seek and destroys. I don't think you are brave enough to trade this, but there's a model called liquidity sweep. Is I forgot about that. I forgot what that model is called. But what ICT does when he trades it is that as soon as price takes out this low, he buys. A turtle soup. It's called a turtle soup. I don't know why it calls a turtle soup, but he calls it a turtle soup. Soup. I really don't know why he calls it that, but he calls it this. So when the algorithm is in a seek and destroy, you'll be trading like this with the 20 pips stop loss. I don't know how many pips 20 pips is. Then you're targeting liquidity. So when the market is trading like this, as soon as it takes out that liquidity, you exit. So you can get nice trades, but trust me, you have to be really brave to buy as soon as you check out that low. So when all the retailers are selling, breakout artists, they are selling below this low. Smart money is buying. So smart money who's trading turtle soups, they are buying there. As soon as every low is taken and every high is taken. As soon as this high is taken as well, this high, as soon as it's taken, or as soon as it even trades to the body there, the highest body, smart money is selling that turtle soup. So you can also exit here, because you exit here and then you enter a sell at the same time. So when you want to do this upward, up down trades, this is how you trade at the turtle soups. So you can trade the turtle soup model on days where you anticipate the seek and destroy bearish profile or bullish in this case. So how you know it's bullish? Well, look at what price is doing from the previous day. Are we in a buy program or a sell program? And then okay, now we're gonna look at this the concept of time. So now we're gonna look at, I'm gonna remove this. So I'm done teaching you turtle soups as far as I know them, to be honest, because then I don't really favor them. I don't trade turtle soups yet, I guess. Okay, let's incorporate the concept of time. So Nasdaq, if you're not trading Nasdaq, you're obviously looking from 9:30, right, when it opens. Nasdaq opens at 9:30. What is happening at 9:30? The method candle opens, rams equal lows, London low, New York session low. Together they make equal lows, relatively equal lows, a double bottom. So you can see price ramming through that. You can see price trade ramming through that. And then what does it do? It comes back to close higher. Next candle goes down to take out liquidity below this low, and then look what it does. It targets buy side liquidity. So now price, as soon as price like takes out this low like aggressively like this, unlike here where it was just turtle swooping, here is it violates the low. That indicates that the seek and destroy is in what is in motion. So basically, smart money is done accumulating orders. They are now ready to let the market move. So they'll let the market move by taking liquidity first. Equal lows, they take out liquidity. Everyone was trying to buy because they thought this was a resistance. They take out all their stop losses. And then what do? The algorithm enters a buy program. So you can see liquidity, buy side liquidity being taken out. But what is actually more important, swing high there. You can see this is the first swing high that gets taken out. So a swing high, I've been teaching that when you see a swing high being taken after taking liquidity, we call that a market structure shift. So this is the 2022 model. I made a video on this, the ICT 2022 model, where he teaches you the ICT 2022 mentorship. So every ICT student should start there basically, but it is what it is. So this is a bullish market structure shift when price trades above a swing high with displacement. What time is price trading to this fair value gap? 10 o'clock. Exactly when you anticipate it. 10 o'clock. The silver bullet. So you see how the silver bullet works. I keep on saying this. So you see how the reason I keep on saying this is because like it also took me so long to see it, to like fully just understand that the silver bullet will be there each and every day. Like it took me a while to accept. I don't know how to lie. I don't lie. The silver bullet, it happens every day. 10 o'clock, price rates with the fair value gap. Anyway, so we see equal highs there being formed by side liquidity. Price comes to, remember, it's a seek and destroy day. So it's a seek and destroy bullish day in this case. So we're still taking liquidity below lows, sweeping them, trading to the order block there. Trades to the order block there, and it forms a nice swing high. That's how you know a swing high is important. Like what the one that trades, that is formed when price trades to the order block or fair value gap. Those are really nice swing highs. For your notes, I didn't put that clearly. So strong swing highs or accurate swing highs are those that are formed when price is rebalancing an order block or redelivering to an order block or rebalancing an imbalance, which is a fair value gap. So this is a bearish order block. It trades with the bearish order block, equal lows. Look at the bodies of the low here. Forget the wicks. Look at the bodies. The bodies are equal. So that is relatively equal lows. We get traded to. We have a swing low there that gets formed. Also takes out liquidity below this wick, this bodies as well. Even this bodies as well. This swing low. So also this swing low formed after price takes out liquidity in the bodies. I'm looking at the bodies. The bodies tell the story. So there's liquidity in these bodies. When it gets traded to here, it gets taken out. A swing low like that is very important. Swing low formed. This one gets taken out after taking out outside liquidity. 2022 model. It happens each and every time. It happened here on a big scale. Now it is happening here on a micro scale. One candle is 5 minutes basically. But even on a 1 minute, it will happen. When that happens, we call this a market structure shift. When price trades aggressively or impulsively with displacement above a swing high after taking out liquidity. Fair value gap, that is a breakaway gap. Why? It is because this is a fair value gap which is formed inside the bullish order block. Guys, I'm teaching you things people can easily charge you, I don't know how much for them. Right here on this channel for free. Just like ICT taught me for free. So yeah, but I can easily charge you, yo, because I know there's some scammer boys who are charging 5,000 for 1 hour. 1 hour. No, no. There's no way you can teach anything like this in 1 hour. Swing high gets taken out. Fair value gap. Price trades with the fair value gap. Price trades with the fair value gap. It runs away. It runs away. And then it breaks out of the fair. It breaks out of the. It breaks out of the order block. As soon as it breaks out of this becomes an order block. So you can see how it supports price basically. Kind of supports price. And then the midpoint of an order block is the main threshold. So many times you see price trading to the main threshold. Yeah, this was calling me. But you don't expect price to trade you don't expect price to trade to close in terms of closing the bodies. You don't expect price to close below the main threshold of a bullish order block if we are bullish. Of a bullish order, what is this? This is a bullish order block. So we don't if we're bullish, yes. So we don't expect price to close below the main threshold of a bullish order block if we're bullish, yes. So that's that. And then the reason I'm getting bored is because it's 12. 12. I don't like going inside the 12 hour when I'm recording. So, but eventually, guys, you see price trading higher and higher and higher. Guess what?